and welcome to Trading Hour, live from the CNBC-TV18 Motilal Oswal studio. I'm Ritu Singh, and with me are Hormaz Patakia and Mangalam Malu. Hormaz, Mangalam, good morning. It's been a weekday of trade. The Rupee obviously weighing in on the sentiments. Both the indices now in the red. Nifty down about 108 points. Sensex down about 288 points as we speak.
Yep, 110 points today, but from record highs down almost 400 points for the frontline index. What's interesting is that the Nifty is just at the 20-day moving average. 25,922 is where the 20-day moving average is. That's where the Nifty is. The Nifty bank is about 200 points away from there. So we'll watch out for how that pans out, because the big trigger for them would obviously be what the RBI has to do on Friday in terms of an outcome from the monetary policy meet. And the one thing that's supporting the frontline index right now from falling much further is the IT pack. So if you pull up, the IT index or any of these large cap IT stocks, they are the beneficiaries or the expected beneficiaries of a weaker rupee. And there you have it. Infosys, a fair weight on the index. TCS, a decent weight on the index itself. The IT index by itself has around 20-25% sort of weight on the frontline index. So when that index is doing well, the only one which is actually in the green right now, it supports the market, and that explains why the Nifty is at an important, technical level as well. The broader markets, though, could do a lot better. Only 700 stocks in the green for about 2,000 which are in the red. So the crisscross lines come up for you. The broader markets, the Nifty mid-cap index at the low point of trade. At the widest is where we have the distance between the red and the green lines. But Hormaz, as always, puts the spotlight on the top movers in the market this hour. Hormaz has walked across to the wall. Hormaz.
Well, not a very pretty looking screen, especially when it comes to the broader markets, as has been the case over the last few sessions now. We'll start off with a losing stock, then Indian Bank. Now, the stock was the best performing PSU bank of the year so far, but the last couple of days have been forgettable ones. Now, 6% lower for Indian Bank. The volumes already at almost 65% of yesterday's volumes already, and 17.5 lakh shares already traded on Indian Bank, the 20-day average of close to 4 lakh shares, so declines on very heavy volumes. And now the stock has moved below its 50-day moving average of 817. Now, why the 50-day MA is crucial? Because it has not closed below that level since July of this year. So it's a very important level for Indian Bank to defend before the close of trade. And why I meant it was the best performing PSU bank, not just this year, but over the last 5 years as well. The stock from almost 80 rupees had gone up to almost 900 rupees in just these last 5 years. Now, bucking the trend in otherwise weak market today is Route Mobile. The stock is up 10%, the biggest single day gain and volumes since June of 2024. Almost 45 lakh shares have been traded already on Route Mobile. The 20-day average here is only 91,000 shares. So gaining on very strong volumes, the stock has moved above its 50-day moving average of 730. And after 5 straight months of losses, the stock has finally gained in the month of December, but continues to remain an underperformer this year, has almost halved in value and was down 13% last year as well. And lastly, Spark, and it continues to have that spark in today's session as well, was up in a 20% circuit yesterday, another 8.5 added today, so almost 31% in the last 2 sessions. The volumes are already double of what yesterday's number was. At 5.5 crore shares have been traded on Spark. The 20-day average is only 4 lakh shares, and this 2-day move has resulted in the stock breaking above all of its key averages and has trimmed its losses now on a year-to-date basis as well. Now down only 13 to 14% is Spark. Back to you guys.
All right, Hormaz, looks like we'll have to slip into a short break there, but we'll keep track of the markets and we're also focusing on the crypto market when we return with Manisha Gupta, so stay tuned for that.
Welcome back. As promised, shifting focus now to the crypto space. Manisha is here with the latest updates. Manisha.
Well, thank you so much for that, Hormaz. While we have seen some bit of a rebound come in for the prices here, but there's another debate that's raging within the crypto space. One, that a lot of money from crypto is going into AI. And the second, is AI going to be more priority than what perhaps blockchain can do? But there are various reports also suggesting that putting the two together perhaps could really work very well strongly going ahead. So let's take at both of these markets first of all. When it comes to artificial intelligence, well, it is known for speed, efficiency and processing, massive data sets there. Also, when you look at the infrastructure part of it, AI is known to be centralized functioning, and then you have high performance computing, which comes with AI. The current impact that we have coming in from artificial intelligence is that it is integrated into financial consumer markets for predictive analytics, risk reduction, and also custom recommendations therein. Now, take a look at what cryptocurrency really does. It utilizes blockchain, and its core strength is decentralization, which is not the case with AI. And then you have more transparency and security, of course, via cryptography there. If you look at the current impact of that, well, we do have decentralized network of computers within. The hurdles and regulation is something, when it comes to mainstream acceptance, that crypto still seems to be facing some headwinds from. But when they both come together is what the world really seems to be working on in sense of various research reports and how perhaps it could change the face of the world in the next 10 years or so. So one is decentralized AI. As of now, AI is centralized while blockchain is decentralized. But decentralized AI is what the street is talking about right now. So with this, crypto can enable decentralized networks, making AI more accessible beyond the large tech companies into mainstream as well. The second thing is about data security, because when you talk about blockchain, you also are talking about transparency and open ledgers here. So this can create an auditable trail for data models used by AI, enhancing trust and security. And finally, it is also about the data economy. Herein, the crypto can facilitate secure data sharing and management. So the movement and various companies and technology firms and large corporates seem to be working is it putting AI and blockchain together.
Manisha, thank you for those updates from the crypto markets now. And getting in a corporate conversation going on the show, Zen Technologies and defense stocks have continued to be in focus, and more so now in looking forward to the visit of Russian President Vladimir Putin towards the end of this week. We are being joined by Ashok Atluri, who is the chairman and managing director at Zen Technologies on the show. Mr. Atluri, good morning. Thank you for joining in. You've completed 4 strategic acquisitions recently, as for your company, is what I'm reading right now. If you could tell us how much are these strategic acquisitions going to benefit you, if they are going to benefit you this year in terms of the P&L, and if not, by when do they start accruing into your balance sheet?
So the companies that we have acquired, two of the one is ARI simulation. They are into naval simulation, and I think they have already started contributing significantly to our both to bottom line and top line. And there are other companies like AI Turing, which we expect to start contributing in the current year. There are a couple of other companies like TISA and which is a loitering munitions company. The other is Vector Techniques, which is into subcomponents and engines for drones. We expect them to start contributing next financial year.
Could you give us a sense on how much Vector Techniques and Bhairav Robotics would contribute to your overall sales? Largely because when you had acquired them, initially put money into them, Vector Technologies had practically zero revenue, as did Bhairav Robotics. So if you could give us a sense on how those businesses are now scaling up and at what level will they start contributing to the revenue?
So, they will I'll not hazard a guess, but next year they'll start contributing. And what we have been insisting on is the products that they make should be unique and the first time in India. And the value addition should be significant so that, R&D is enabled with the margins that we have. So, but the exact, probably, by early next year, we should have some figures in hand.
Have any proof of concepts around? Have you, signed any letters of intent?
Yeah, I mean, the demonstrations are going on for like AI Turing has been demonstrating the remote control weapon stations, and we expect them to contribute in the current year itself. But so that is going on. And in the meantime, we are going to attend US world's largest simulation exhibition in US, where we are looking to show showcase our products, which is an outreach for the exports at this point in time. And we find it very, very interesting because, what has happened in US is a dramatic shift from earlier slow paced procurement. Now they're moving very, very fast. In fact, there are 12 agencies. They have collapsed them into 6 agencies called Program Acquisition Executives. And which is what is really good for Zen Technologies is that earlier they would insist on a huge presentation paperwork for shortlisting companies. And this would be all talk and, no walk in the sense. But now they are saying, but if you have a product, please come and demonstrate. If you like, we will buy it. And then, if we, after buying, we'll test it out. If you like it, we'll scale it up. So this is huge for companies like Zell Technologies, because we are completely self-funded R&D, and we are looking at really scaling up in US and for both US and NATO markets. So this begins a very big opportunity, and this is borne out by their experience with in the US setup. They have seen companies like Lockheed, Boeing tied up with NASA and for 20 years doing cost plus basis R&D, but not flying a single rocket. And then they saw a company with skin in the game, self-funding the R&D and saying, pay me only if my rocket flies. SpaceX. So, we see the SpaceX advantage. So
Got that, Mr. Atluri.
Actual reality. Yeah, sorry.
Yeah, sorry to interrupt there, but, you've got this contract of 108 crores from the government for the supply of tank crew gunnery training simulators. Just give us a sense of what ordering activity in the second half will look like. The first half has been pretty weak. Where do you think you'll end FY26 with?
So I think the two things which were happening, one is the procurement was going on for the regular orders. And then what happened suddenly was the operation, the crisis happened, Operation Sindoor crisis. After post that, the regular procurement was slowed down and much focus was given on the emergency procurement, which we expect to conclude in a month's time. And so the regular orders that we were expecting around September never materialized. But they have started materializing. In a couple of them, we have got it already. But overall, I think the second half will be heavy with the orders, and we have already started getting this. Not only the 108, but we got the for the anti-drone system, almost 300 plus crores. One was a Rupee, or order to upgrade the existing system. The second was for the hard kill. So, really, really cutting edge orders in anti-drone system and simulators also, for the tank simulator, etc. We expect the simulator orders to scale up as we speak.
So in that case, Mr. Atluri, if you are expecting these orders to scale up, where do you end FY26 in terms of revenues and margins, and the same for FY27 as well?
So, at this point of time, we are not exactly going year-wise, but, what I can say is this, that, we were expecting a cumulative turnover of 6,000 crores plus over 26, 27, 28. But 26, unfortunately, will be very muted year because of the various reasons that I have shared just now. But what we think is both for 27 and 28, we will be able to make up the difference and try to deliver the total figure that we had envisaged.
All right, we take that point. So FY26 to 28, that 6,000 crore now shifts to 27 and 28 and not beyond 28, right?
Yeah.
All right, take that point. So next 2 years have a lot to do, weightlifting of almost 3,000 crores every year in terms of top line. Now, will that be front-ended or back-ended?
Again, what I'm saying is 6,000 crores for the 3 years. So whatever we do this year, you have to take it out. And the remaining, whatever left out of the 6,000 will be achieved in 27 and 28. So, again, I probably it will, both years will be maybe, I think 27 would definitely be not as big as 28.
All right, take that point. Thank you, Mr. Atluri, for joining in. We take a short break. On the other side, our big story, the rupee has breached the 90 mark as against the dollar for the first time at an all-time low. What impacts could it create on sectors? We'll discuss that. Stay with us.
Welcome back. Still 120 points down on the index, fighting to hold that 25,900 mark. But it's big story time. Unsurprisingly, it's about the rupee, and our entire battery of research experts at CNBC-TV18 are here to take us through the impact that the fall in the rupee will have. But first up, Ritu, you have to tell us more about the rupee and the record low that it fell to in today's session as well.
Well, yes, it breached that 90 level psychological mark for the first time ever, hitting a fresh record low this morning. The rupee actually opened at 89.96, and within seconds, I think in less than a minute, we saw it crossing that 90 mark pretty much immediately. No RBI support really coming in on those levels as was expected. This sharp depreciation is almost 5% this year because capital outflows continue from the foreign investors. They pulled out nearly $17 billion this year, and that, of course, coupled with the strong dollar demand, we've been seeing the subdued domestic equities, which makes the market unattractive. And importantly, the lack of any progress on the US-India trade deal. We pretty much know the reasons that are weighing on the sentiments as far as rupee is concerned. And this pressure, experts we've been speaking to say will persist in the near term. But do keep in mind, we have adequate reserves. I think last was about $688 billion disclosed data. Good for, of course, importers. For exporters, rather, not so good for importers.
All right. Not so good for importers. So what we'll do is then we'll find out about the sectors that benefit from it, the exporters, in particular the IT space, service exports. And that's the only index which is actually in the green right now as we speak. Rima joins in to tell us the impact alongside all the others who will talk about their specific sectors. Rima.
Thanks so much for that. So, before we get to INR depreciation, once again to reiterate that the Indian IT sector has been an underperformer. Year to date, the Nifty IT index is down 13%, though it started recovering from the 52-week lows. So from the 52-week low, the index has recovered more than 20%, but it's still down year to date. And from its all-time high level, Hormuz told me it's down close to about 18%. So, one of the drivers for the sentiment today is the INR depreciation. Typically, the simple math tells you that a 1% rupee depreciation benefits margins by about 25 to 30 basis points. But then again, it depends on the kind of hedge ratio companies have. But, outside of that, one reason for the increasing optimism surrounding or why IT stocks and shares are seeing a look in is the underperformance. And also now the AI infrastructure. The global AI trade is moving from infra build out. They're saying eventually maybe that's going to peak out at some point of time. There is diminishing marginal utility, and the focus will shift to application services and maintenance. And this will, unlock net AI revenue for the sector 12 to 18 months down the line. And plus, yesterday when we were talking to experts, they're saying assuming the Indian IT companies grow by 5-6%, plus you throw in a dividend yield, that makes it fairly attractive, and therefore it's time perhaps for to take a look in at the sector.
The only sectoral gainer in today's session is the IT index. Rima, thank you for that update. From IT, we move to pharma. Ekta, tell us more on that.
Well, yes, for when it comes to the rupee depreciation and pharmaceuticals, what the analysts have indicated is that it is a short-term impact. The impact of the rupee depreciation is positive, but it is limited. So that's because most of the Indian pharmaceutical companies hedge their USD exposure. Now, there will be a temporary gain in terms of realization of export sales, but there are input costs. So the equation for each pharmaceutical company depends on how much they do import in terms of input costs and how much do they export. So a lot of the companies who do have exports to the US will be benefiting from the rupee depreciation. Now, the input costs also will rise temporarily, but companies will be negotiating with vendors. Remember that the rupee has depreciated continuously over the past couple of years, and hence the pharmaceutical companies are quite well-versed in terms of the negotiations and in terms of the impact as well.
All right, let's go across to Sudarshan for autos. Sudarshan, those with a bit of an export bias will be happy.
That's correct. So while the auto companies or auto stocks are today under pressure, but there are certain companies or the pockets from the auto sector that will benefit the most from rupee's fall against US dollar. And first on the list is TVS Motor, because 30% of its total volumes come from export. And as far as revenue is concerned, exports form nearly 25 to 26% of the revenue. Second name is Bajaj Auto. Almost 50% of its revenue comes from the export segment. And in Q2 FY26, dollar realization was 87.1. So I did certain calculation. So in Q3, dollar realization increases to 89. And management today early in the morning has said if there is a fall of rupee 1 against US dollar, it lifts EBITDA, annualized EBITDA by almost rupees 200 crores. So you can do the calculation, what can the increase be. Now coming to auto ancillaries, I have taken three names. Samvardhana Motherson, Bharat Forge, and Minda. Samvardhana Motherson, it would be a minor positive because 60 to 65% of their total revenue comes from the export segment, but they do have the manufacturing base in the US and Europe, so that will increase the costs as well. Coming to Bharat Forge, for Bharat Forge, 60% of the revenue comes from the export segment, and they have majorly three businesses. First one is Class 8, then PV EV components, and the last one is forging business, which is a high margin business. So Bharat Forge will be impacted positively, like hugely positive it would be for them. Coming to Uno Minda, it would be a negative for them because they have the 70% of the revenue comes from domestic business. So now it will increase the import cost because they import chips and all the other components. That's the reason they are majorly dependent on the import. So it would be negative for them. So it would be a mixed impact, but majorly positive for few companies.
Take that majorly positive for a few companies, but a couple of companies their import bill increases. What happens to the oil and gas and chemical companies? Sonal joins in to wrap this up.
Well, let me start with oil and gas companies. It's going to be a mixed bag. Let's start with the oil producers. Of course, they will tend to benefit from this because their realizations are dollar denominated. So every 1 rupee depreciation improves EPS for ONGC and Oil India by 1 to 2%. For Petronel LNG, their regasification margins are linked to dollar, and that's the reason why they will improve their EPS by 1 to 3%. For OMCs, it's a mixed bag. They will see some imports as well, but yes, their GRMs, they are dollar denominated. So 11% improvement in EPS due to 1 rupee depreciation. For city gas distribution companies, it could be a negative because remember, they import a large part of their LNG, and that is something which would impact their EPS by 4 to 11% negatively. For chemicals, it's a huge basket, right? So can't talk about all the stocks, but some of them which have a large exposure to the US and they get dollar-denominated revenues there, something like an SRF, we have Aarti Industries, Atul Limited, Naveen Fluorine, all of them tend to benefit because of the depreciation that we've been seeing in rupee.
Sonal, thank you for that and for summarizing all of it. And thank you to Reema, Ekta, Sudarshan as well as Ritu for taking us through the depreciation in the rupee and the impact on various sectors as well. The rupee at a new low, the index also making an intraday low 25,891 and now is staging a bit of a rebound from those levels. Take a short break, continue our conversations with the markets with Ashi Anand from IME Capital on the other side.
Flirting around with the 25,900 mark for the Nifty. You're watching us here on Trading Hour, and this is from the FNO desk. If you look at the frontline indices, the Nifty underperforming, the Nifty Bank falling even more. And if we have the mid-cap index, the broader markets would tell you that the portfolios are hurting. The only index which is outperforming right now on account of the weaker rupee is the IT pack. And we had Reema tell us that in the last segment as well. Remember, the IT index has been an underperformer, but now moving off lows with the additional benefit coming in on the weaker rupee. So we have the top names like Wipro, TCS, Infosys, all of them doing particularly well. But another, sector which gets impacted by a weaker rupee are the PSU space. So you look at the SBI stock, BEL, NTPC, and in that the PSU banks in particular even more so because that has a correlation with the bond prices. The bond prices fall when the rupee weakens, the bond yields rise, and that impacts their mark-to-market books as well on the overall performance. So we have Indian Bank, PNB, Bank of Baroda, Canara Bank, all of them selling off fairly sharply. The important levels to watch out for: Nifty just below the 20-day moving average at 25,922. The Nifty Bank at 58,771, about 100 point away from the 20-day moving average. Can we hold on to these levels and close above them? That's what the bulls would want. And as far as the options data is concerned, tells you that on the markets above 26,000, there is a fair amount of supply. And these are options that expire next Tuesday. So 114 rupees on the 26,000 call in terms of premium, 1.8 crore shares outstanding, a crore and a half added today itself, telling you upwards of 26,100, there could be supply for the market. But at lower levels, there is some support around 25,800. Why do I say that? Because the 25,900 put also seen a fair amount of writing at around 1 crore shares outstanding open interest, 100 rupees in premium. So 25,800 to 26,100 is the broad range that the street is working with for the very near term.
All right, Manglam, thanks for bringing us that update. We have with us a guest in the studio, Mr. Ashi Anand, CEO and founder at IME Capital, joins us now. Mr. Anand, thanks very much for being here. You're quite bullish on the whole digital space and, in particular, fintech as well. You hold significant, stakes in the likes of Paytm, for instance. Tell us your thesis on those kind of companies. I mean, the only recent positive, so to speak, we've seen on Paytm, a stock like that, has been the payment aggregator license that's come in. But what is the upside from here on, given how the regulatory overhang has been a big concern on that stock?
Sure. So actually, if I can just start off first by just talking about the overall thesis, because Paytm really fits within that.
Yeah.
I think what we are seeing very, very clearly is a very sharp value migration that is taking place from traditional businesses towards kind of new age digital first platforms. And you're seeing this across industry segments. This is a structural kind of theme that we believe is only going to accelerate as we go forward, as kind of the newer generations come in more into the consumer class. That is where that trend we believe will only just accelerate. So you have very, very robust kind of trends in terms of growth towards these new age digital companies. A very important element about digital platforms is that these businesses also tend to move or gravitate towards monopoly, duopoly, or very tight oligopoly kind of structures. So very large markets end up being consolidated within a few companies. Now, that is something similar that we're kind of seeing in the kind of payment space or in the kind of overall fintech space. Now, if you're looking at a company like Paytm, while there is clearly a traditional payments business, right, and that's the core of the current business, what is really very interesting is the longer-term monetization capabilities of as Paytm kind of really starts flexing its muscles around lending, around capital markets, the kind of distribution that Paytm has. And these are a very large part of its consumers are consumers that the traditional finance companies could not really reach. You've seen a recent IPO grow, right? And the kind of growth they've had of extremely kind of in a very short period of time. So I think what is interesting to us about Paytm is not what's currently there, but as you go 3-5 years down the line,
the potential.
The potential and the kind of incremental flow through of revenues to profits in financial services. It's a pure distribution business. That is really very interesting, and we see a lot of value being created.
We understand, and it's a big prospect from a long-term standpoint, etc. But just to play devil's advocate here, because what we've seen, barring the food tech companies, which have now migrated fairly well to the quick commerce companies, a lot of these digital natives, a lot of these companies invariably fail at the next leg of evolution. So a lot of the brokers, the discount brokers, etc., will not extrapolate that gain into financial services as much. Or a lot of the, say for instance, back in the day we had Naukri, InfoEdge, it still forms a large part of their overall business. They've not captured that sort of moat into other things. So is that a risk? Say for instance, a lot of people using Paytm right now, but maybe as they come up with ancillary services or some other app gets the benefit of that a lot better than what these guys could.
So actually, that's the interesting point, right? And I think that is really one of the core of when we are evaluating digital platforms, understanding how easy is it to kind of be able to launch or kind of come up with supplementary services that kind of add incremental value. Now, if you look at Paytm as an example, before this kind of recent weakness in kind of unsecured lending, they launched kind of lending on the platform and just BNPL and personal loans. In a year and a half of their launch, they had crossed a dispersal run rate of SBI cards, the second largest issuer of cards in the country. Right? So in terms of do users on the platform are they willing to use on other services? I think that is quite clearly demonstrated in the case of Paytm. Right now, you've had the kind of regulatory issues. You've also had weakness in unsecured lending, so that part had gone a bit slow. But you clearly do see that kind of potential, right, in terms of just the kind of scale that can come in quite rapidly. So when we do look at kind of digital platforms, right, the whole core is in terms of the monetization. How clear is that? So say, for example, when we had launched our digital disruption strategy in Feb 23, at a time when these stocks had been hammered, they were down 50-70% post the IPO. And I think our core call was that if you do study their cost structures and you understand the kind of monetization levers, these companies can be incredibly profitable over the longer term. But you really have to, there are few assumptions that have to be tested. So say, for example, back then, Zomato and Swiggy did not have platform fees. There were hardly any delivery fees before that. Delivery fees were just introduced post-COVID. But as they kind of added on monetization kind of levers, consumers, I think the core call on digital platforms is that once a platform has achieved a certain level of dominance and strength, it becomes very difficult to replace them. And then suddenly users, they don't have an option. You are not going to not order pizza because there's a 5 rupee platform.
So just before we let you go, and you spoke about the platform fees, etc., where do you stand on Meesho? Because they've gone on record saying that they will never have commissions, they will never have platform fees.
Yeah.
So Meesho has no commissions, has no platform fees. They have a 30% take rate. It's amongst the highest in the industry.
Yeah.
Right? So you don't need to make money. There are multiple different forms of monetization.
Yeah.
Meesho, I think, monetizes advertising income is a very big part.
Right.
And the whole logistics orchestration that they do, which is amazing, right?
So you like it?
It's an IPO, right? So we do have to be a bit particular, but I think as a business, it is really quite remarkable in a period of 5 years to kind of come in and compete against giants like an Amazon and a Flipkart.
Yeah.
And does that have a threat to delivery as well? Because I was just reading a note yesterday that said that their insourcing model is going to be a threat to delivery's core business. So does that become a threat? Because delivery as a stock in general has not done well anyway.
So in fact, one of the big reasons has been Meesho's insourcing that they've already been doing.
Yeah.
And I think the interesting part about how Meesho has done it, they've been able to do this without actually building out the logistics infra itself, just creating a kind of tech layer to build out the logistics. So yes, I think a part of delivery's underperformance could kind of be linked to that. But I think delivery still, in terms of a logistics company, is one of the most attractive logistics companies from a longer term perspective. So that is a company that we still do like, but Meesho is clearly a headwind.
Right, Ashi, thank you so much for sparing time and joining us today with your views on these interesting insights on this conversation.
Are you where would you put Lenskart? As a tech company or a retail company?
So we're having huge debates on that internally.
Got it.
According to us, so if you're looking at a company like a Lenskart, you're looking at a company like a Mamaearth, there are quite a few of these companies that kind of are kind of digital first, but the whole omni-channel and the physical infra is quite
Digital
important.
is what the street is calling them.
Yes, so I think we prefer pure digital companies. It's much easier to kind of scale very rapidly in those models. Though these are, I think, amongst the next best bet. Right. I think a lot of traditional businesses which aren't incorporating digital in a big way are going to kind of suffer from.
They're your one-down betters. Thank you so much, Ashish.
Thank you so much for having me.
With that, we'll take a short break, come back, get you more on the markets and a lot of individual stock-specific action. Stay with us. Welcome back. In a wobbly market, what was a good gainer yesterday was Asian Paints. In fact, from its lows, the stock has gained about 40% on improving demand and reducing competitive intensity perception. In an exclusive conversation with us, the management decodes the events of the last 2 years, what the future looks like right now, and more importantly, when the company decides to pull the plug on their home improvement business, which hasn't been doing as well.
I think this pressure has always been there. You know, if I look back last 2 decades, it's been always there. Just that today the number of players who are coming and trying to take a dig at it is much more to that extent. And I think that's something which is good because it also, as a leader, keeps us on toes in terms of thinking what is the differential thing in terms of what you are kind of really talking of. And that's why I keep on saying that, you know, we will keep on creating trends. People have to make case studies out of it.
For me personally, one of the things which is a perpetual disappointment from an Asian Paints standpoint is the non-paints home decor business.
Sure.
It's definitely not gone down the way analysts expected, perhaps not gone down the way you expected it as well. Some of the bolt-on acquisitions that were made did not go down well. They were perhaps strategic missteps, so to say. Some of the targets that you've given haven't been met. And for a company the size of Asian Paints, any new foray, one would have imagined would be big, bold, and something not very different from what others would do in the paint industry.
Yeah.
So what was the problem there?
So I feel that, you know, the way we anticipated the market, we were here not fighting any organized competition. We were fighting unorganized sector. And what we didn't realize in the unorganized sector is that the flexibility of pricing, the flexibility of the way they are able to kind of regionalize the product, I think was something which was very, very high. So I think it has taken us some time. We have put about 70 beautiful home stores across the country. The stores are doing well. But when you compare to the size of what we do in coatings, obviously the size is very, very small in terms of what's happening. And what you say is right. Some of the acquisitions which we did, we kind of grew them in the first 2-3 years, but then we were not able to sustain that kind of a buoyancy in terms of what happened to that extent. But as we see it, I think it's an integral part of our strategy because we feel that if you own homes, okay, one of the big things which Asian Paints does is that as part of Har Ghar, you can't just own surfaces, you have to own spaces. And today decor gives us that big rope in terms of looking at owning spaces. And we feel that that's a very big differentiator for us, because if you were to kind of put all the brands today, okay, only one brand today appropriates home, and that is Asian Paints. And that is where possibly the decor strategy is still very, very relevant to us in terms of where it stands. Yes, we have a task in terms of how we need to kind of put it into shape and get it back rolling to that extent, but we are committed to it.
And how long will that commitment last, and at what point will you believe that, okay, we've put enough resources, mind space and ideas behind it, but maybe it's just time to pull the plug?
So we are giving ourselves another 2 years in terms of looking at really getting behind it in terms of what we want to achieve, what we want to do to that extent, and really seeing that we can bring excellence in those categories, which is what Asian Paints style of business is.
And what would the end of those 2 years look like for you to call it a success in terms of numbers?
So we are looking at a certain contribution which that decor piece which kind of gives us, and we are looking at something like about a 7 to 8% contribution to our overall business in terms of what will be there to that extent. And that is something which possibly would be an indication that we are on a right trajectory.
And in coatings itself, what is your aspiration? Because right now, obviously, a large part comes in from repainting. Then there is a certain part which comes in from, the new buildings which are announced. And thereafter, there is this new TAM which is opened up, which is government-led infra.
Yeah.
Do you have an ideal mix here?
So see, when you look at today, I think the trend which we are seeing is that the whole area of the industrial and the B2B space is changing quite a bit, and that is really expanding, given the fact that you're talking of private capex and you're talking of government investment, which is coming in a very big way, which I believe will continue to that extent. And therefore, one of the big focus which we are taking is basically the B2B and the industrial business, in terms of where our contributions are relatively less as compared to possibly some of the competition in terms of what is there. So that's the new piece in terms of the growth trajectory in terms of what we are taking in a very big way to that extent, apart from the fact that the retail excellence will continue in terms of what we are doing to that extent, and that would kind of really see that it kind of firmly pegs us amongst the top 5 global players in the world.
So if I had to look at Asian Paints 3 years from now, what according to you would the revenue mix be? How much comes in from decorative? How much comes in from B2B? In decorative, how much comes in from retail decorative, and how much comes in from, say, government infra or all the housing projects, etc.? How much comes in from home decor and how much comes in from international?
See, roughly, if you look at it, basically the whole coatings landscape, overall, when we say from a point of view of a decorative, that will still lie in a band of about 78 to 80% in terms of as I see it. And out of that, possibly about a 20% contribution would come in from the B2B business to that extent. When you look at the industrial business, I think that will continue to kind of go on to a realm of something like about 8 to 10%, and global would be another 10% to that extent.
All right. And, you will still be 18 to 20% margins at that point.
That's what we are kind of dwelling at very strongly.
There is some recovery from the lows of the day, so around 40 odd points on the Nifty, still down 100. The mid-cap index, though, has seen a bit of a 50-point recovery from the low, still down 550. The indices continue to remain in the red as we head into the second half of the trading session. Take a leave on this edition of Trading Hour. From Manglam, Ritu and me, thank you for watching. Halftime report on the other side.